welcome to the View from the 8th, the Leeds take on the Allsop Prep Chat. Today we're Sam Verity, Brad Harris and me, Jack Robson. Today we'll dive into the views on the current market, the underwhelming budget, build to rent or sell, or maybe a collaboration, amenity in the development, and their take on the future of both markets. Chaps, welcome. Brad, intro, time at Allsop and in the industry.
Thanks, Jack. So I've been working in residential development for about 12 years in total now. So it's kind of my day-to-day, it's my bread and butter, as we all call it. And traditionally, I'm working with landowners to bring their sites forward to sell to house builders and try and deliver housing, which is much needed in the country.
And Sam Verity, or Vez, as we all call you.
Cheers, Wacko. Yeah, Sam Verity, build to rent team at Allsop. I've been at Allsop for 8.5 years now. So came on the grad scheme in London and then moved into the build to rent team in about 2017 and actually then moved to Leeds in 2020. So my role is multifamily, single family housing, build to rent, advising national, regional developers, working with institutional investors, PE, a range of investors across various different schemes, and yeah.
Great stuff. So what does your client look like, Vez? You know, what type of property individual or company are they?
It does vary depending on where we're looking at multifamily or single family housing. So on the multi side, it is regional and national developers, city centre focused land opportunities. We'll generally work with them on looking at sites, whether they've got a site or looking to buy, getting them up to speed with, you know, what the requirements are from our relationship with investors who we're speaking to on a daily basis, and sort of helping them through designing and bringing a build to rent project to life. On the single family housing side, again, that is national remit and kind of looking on the developer side, but more and more looking and working with institutional investors and PEs who are looking to acquire houses across the UK.
So if build to rent is the headline, you've mentioned two things I wanted to get into. You've mentioned multifamily and single family. Just explain very briefly, please, what exactly those two look like.
So multifamily is probably the more recognised city centre flats, normally with amenities there, based at the young professionals predominantly. Single family housing is family housing essentially, and doesn't differ too much from the stuff that Brad's involved with. It's plots of houses which are rented by families. And
that's where I think we'll merge and what I'd like to get into. But Brad, same question regarding client type for you. Let's say 80-90% of your day-to-day job, you know, what do those clients look like?
It's really a complete variety of clients from my perspective. You may have the person that's bought their 4-bedroom detached that had a big garden and they've converted it into essentially a plot for a care home, or, you know, a plot for 2 or 3 houses, or it may be the complete other end of the spectrum where you've got a national company who own swathes of land looking to redevelop. You know, planning promoters that will take on option agreements on land and move them forward through the planning system over several years. The other side, you may have parties that come forward that don't have any form of planning permission and look to take on advice and move their sites forward. So it really covers a complete range from, you know, anything up to, say, 5 units, as we call it, or to the top end, it could be 1,000. I think particularly on that top end, that's where Vez and myself have a bit of crossover. We're now looking at sites more generally for traditional volume house builders and the investor side, where you may have a landowner that's looking for the long-term hold. So they may sell something early on to bring some initial money in, but then look for a longer-term play on the investment. So there's really becoming more and more crossover. But going back to your point, you know, client-wise, it can be anyone who owns some land, essentially.
Yeah, fine. And I want to get stuck into the current market. The planning system, I don't want to get too far into this, but is it a barrier for house building? Open to either of you?
I suppose that probably falls to me first and foremost, where, you know, acting with the volume house builders and the SMEs for that matter as well, is, yes, planning is a barrier. I think everyone involved in property is aware of that, but I think it's wrong to sit here and point the finger at councils and say it's all your fault. You know, they're very under-resourced, they've got a difficult job, and I'm sure on a day-to-day basis there's planning applications getting thrown at them, there's big PLC shouting down the throats that, we want things to happen. So yes, planning is difficult. It is for everyone. The flip side to all that, and I think it's something that we don't often reflect on, is that planning difficulty creates more demand, and it creates the higher returns for landowners and developers, really.
But also a higher price for those trying to buy houses.
Yeah, of course. Yeah.
Vez, how does planning work in your space? And I guess the other question is, build to rent is a bit of a buzzword. Are councils quite receptive to it?
Yeah, I think at the start of the sector, when it first came to the UK, probably 8, 9, 10 years ago now, it was unknown, and developers, investors were all kind of learning on the job and getting educated about the sector. I think it's now fully recognised across the UK and even into smaller local authorities where the single family housing is coming. Councillors are understanding what that is as a product. I would echo what Brad has said. It has slowed deals down. We've been on deals where we've been in planning for 18, 24 months. And
how long would you expect that to look, typically? Not 18 months, I guess.
Yeah, I think, with all things well, you're kind of looking at a 9 to 12 months from start to finish.
I just want to change tack a little bit back to Brad and your sort of clients. Redrow and Barratt look like they're trying to merge.
Yeah.
I know the Competition and Market Authority are reviewing it currently. That can't be good for the sector, can it?
Difficult to say.
It's going to sit on the fence.
I think sitting on the fence is probably the answer. Yes and no. I mean, you've got Barratt's, who are the biggest around, really, them and Persimmon anyway, and you're still going to have competition in the market. Yes, it's, from our perspective, you say it's one less competitor, but from what I gather, and I'm sure Barratt and Redrow have their own view on this, but from what I gather, there will still be essentially 2 house builders there. So perhaps we haven't actually lost a house builder. Yes, the fact that we've got one of the biggest house builders getting bigger, but these things happen. Persimmon have bought house builders over the years. Only a couple of years ago, Vistry and Countryside had their merger. So these things will always happen. You still look and say there are still ample of other PLC house builders out there. So it will be very interesting. It'll be interesting to see how their bidding goes on sites and what side of Redrow and what side of Barratt's we see moving forward. But yeah, could it impact on the smaller house builders? Potentially. We don't know. We're going to have to wait and see. So
sure.
Certainly interesting for the market, though.
And I want to get into the budget, but I just want to touch on PD. We're talking about developments. You've both touched on city centre stuff and PD being permitted development. There's been some changes recently. There is going to be a podcast to follow with some of our London colleagues. Is there anything either of you would like to just comment on that? The answer can be no.
I think it's going to be helpful. I think there was PD previously that did help some of those, particularly city centre and fringe city centre offices, come forward for development at a time when, coming out of COVID, there was a lot of nervousness around the market for those types of offices. And it did help. We saw quite a few opportunities. We as a business dealt with a lot of opportunities in that PD sector. So I think it's only a good thing.
And to clarify, this is ultimately the ability to convert our type of building to residential.
Yeah. That's what we've seen the majority of. So you may have, disused business parks on the edge of city centres where now you can see some potential residential play coming forward. So yeah, I think it's a good thing for the market. I think it's hopefully a way of seeing some disused office space come forward, or for those vendors, they're getting maximum value for their offices. So,
but does it change much for you, I suspect?
No, not really. We haven't seen much of it in the market. It's, it is a bit more difficult because you are restricted of what you can do with buildings. It just means that you can't have what you want and potentially impacting efficiencies.
Yeah, fine. So the budget. We set out with this podcast with a view to speaking of housing initiatives we were hoping for, expecting, whichever way you want to look at it. It was pretty underwhelming.
I think that's fair to say. Certainly from
our
building
point of view,
the house building perspective, I think we all thought that there might be something like a Help to Buy Mark II, or some sort of incentive around mortgages, etc. Would that have made things any better? I don't know. I think it's quite difficult for the government to do something for housing at a time when the Bank of England are keeping rates high, so it almost contradicts one another. Would we have liked to have seen it from a market stimulus perspective, whatever that stimulus was? Yes, I think it would have been great, because a bit more confidence in a market that could do with more confidence would be helpful. But Mr. Hunt might be just saving that one for later down the line when he might need a bigger card to play.
Yeah. So in my world, that being residential investments, blocks of flats, I understand our buyers take advantage of a thing called multiple dwelling relief.
Or could
take advantage of it. It's something that allows a lower tax bill in a world full of taxes. Vez, I don't think the build to rent sector have taken the changes or basically the abolishment of MDR very well, have they?
They haven't, and there has been quite a bit of press saying that it's going to hit the BTR sector quite hard. I think it's a sector which is used to getting hit by difficulties. And I think we've seen that it is a sector which can and does overcome those setbacks. The resilience of the market will crack on. In my view, potential of other sectors may be hit harder than BTR. I think it will definitely have an effect, particularly in cash flows where your exit price is going to be naturally lower because you're going to have higher purchase costs. But there's other factors to factor into that, such as hold periods, etc., rental growth. And we haven't seen many stabilised transactions in the BTR sector, but I would argue that the majority of those have been SPV transactions, and therefore this actual realised price wouldn't have altered with NDR.
Fine, because we're talking about stamp duty here, and if I'm buying my home, I know that a more expensive home results in a higher stamp duty bill. If I'm buying a 30, 40, 50 million pound block of flats, I suspect that would be quite a high bill. MDR has been used in these instances to lower that tax bill. Have you got an idea on what the change or getting rid of it how it might look in terms of numbers?
It's going to vary on location to location because, as soon as you get to a certain capital value per unit, then MDR actually wasn't helping you.
Interesting.
So it is the lower value areas which will be more impacted, and that could look like anything from 2.5% additional purchase costs.
Interesting. So I think we can move on quite quickly from the budget, to be fair.
Not much more to add.
Yeah. I want to consider the scenario where I'm a landowner and pitch you against each other. And, I think we've sort of touched on the areas where, your sort of areas of speciality merge maybe. If I'm a landowner, first of all, what has that land, what has it got to look like? What has it got to offer you, Brad, or your clients, your house builders, let's say, for them to wake up and make an offer?
It's a very generic question in the sense of, how long's this piece of string really? I think probably from my perspective, it comes more down to things like timescales and where the planning position is. If you literally come knock on our door and say that I have a piece of land and I don't know what to do with it, typically, if it's a smaller plot of land in say, a village or the outskirts of a village or what have you, it will work better for traditional housing, just based on the unit numbers that investors look for. So if, for example, it was 20 homes on the edge of a nice Yorkshire village, then I would say 9 times out of 10 that's going to come forward for traditional housing. I think, Vez will look at things on a different scale, but, my approach to things are very much, you need to get the right consultants on board, you need to get the right planning permission on board, and then essentially you've got your exit, which is the house builder comes along and buys that from you. So start to finish, it's easier to sort of see where that start and that finish line is. Whereas, we sit here and we have a joke with Vez about how long things take in his world, and, they take a long time in mine too. But it really depends, I think, as the landowner, where you want your exit to be. And
I suspect as a landowner, you want to make the most money as you possibly can.
Well, that's what I mean. You've got two sides to that and two answers to that. And one could be, sell it quickly to a house builder, and one could be take the long-term view. I suppose Vez will jump in at that point and explain what that long-term view is.
Let's do that, because Brad, I appreciate you've mentioned that, I could have a big garden and, ultimately still get a house builder interested, which is interesting. There must be a minimum site size for build to rent, and indeed, same questions. Brad talks about maybe a village location. How does that look from? I suspect build to rent investors aren't looking next to local villages.
No, it's difficult. We kind of start to get excited at 75 units plus, depending on where that could be. We could dip down to 50,
and this is a single family.
This is single family housing. Yeah, so talking about the houses now, that site needs to be well located in terms of employment. So whether that's in close proximity to a city or town centre, or we're seeing new Amazon warehouses pop up, which brings an awful amount of employment to an area. So good road communications and transport hubs and town city centres.
And now, that you'd expect those things to be interested to the house builds on Brad's side as well, but ultimately you're looking to rent these properties. When it comes down to city centre stuff, the blocks of flats, these are being rented at prices much higher than the sort of general market level for developments maybe that don't have amenities. How does that look when you've got a 75 unit site, let's say near an Amazon hub or otherwise? Are these rents higher than the market level? Are they similar to the market level?
It depends. It depends what
we're not very good at answering questions.
Very political.
What are you comparing that rent to? Because in truth, there's not many comparable like for like new build houses. They just don't really come to the rental market. You're not seeing a buy to let landlord buying them and renting them out. So the comparable evidence is other single family housing schemes, and there's not a whole host of them across the UK, that are operational at present. So yes, if you're comparing to an older terrace house, then there is going to be a rental premium.
Just like there would be a premium on a new build house if you were buying.
Yeah, I think the other thing to add as well is that we're comparing one very well established market versus one that, as you said, is 8 to 10 years old. So there's an awful lot of comparable evidence that can go on the traditional land side, whether that's supporting comparables or land values, but on the build to rent side, it's a very different market, and it is a new market, and even more so on the single family housing side of it.
Mm-hmm. And we had a brief chat beforehand, and Brad, your clients are traditionally the builders of this stuff, and Vez, you're dealing with more of this, well, you said PE quite a lot, is that private equity?
Yeah.
And other investors and funds. I suspect, Vez, your clients are buying off your client's Brad, as in...
Exactly.
Yeah. And ultimately the product that the house builder is building on let's say your sites of 75 plus, has that changed at all for the build to rent investors?
I think it's slightly different. Fundamentally it's the same, but I think investors are more leaning towards 2 and 3 bed houses and away from the sort of larger 4 or 5 bed detached houses. So if you're looking at a similar site, there may be an argument where you could potentially get more units per acre on a single family housing scheme.
I think there's certainly a lot of crossover now in the house builders accepting that investors are in the marketplace. I think we've gone through all sorts of different market conditions over the past few years, and we're now in a place where the house building sector isn't performing like it once was. By that I mean, coming out of COVID, there was a very good period of time for the house builders to sell. There were no incentives being offered. There was no interest in an investor coming and buying, say, 50, 75 plots off them. That market has changed a bit more now. And
sorry to jump in, Raj, that's interesting. I really want to talk about that, because that's ultimately what you're saying is there was a time, and I'm sure there will be time again, when building those and selling all those houses off individually to you and I is the best way to maximize value from your site, let's say.
Yeah.
But now, because the market's shifted and there's not as much demand, there is that place where a build-to-rent investor can come in, and I suspect won't be very happy taking the remainder of a site, but could certainly get into a place where they forward fund or forward commit or take on a new site. Is that what we're saying?
Yeah, I don't think they'd argue taking the last 50 units per site.
Interesting. Do you think that will go back the other way? As in,
I don't. Yes and no. I suspect in a use post-COVID as a market time, that was a market where there was an awful lot on the side of the house builders, and there was no need to entertain the idea of bulk sales. Will that market come again? I think we all want a market like that again, because it was a good time to be a seller. We're now in a buyer's market, and it's a bit different. I think there's going to be, moving forward, there's going to be a lot more synergy between the two, which there hadn't previously been. But I think that also goes back to the point of this has been and is still a new market. So naturally, moving forward, you would think that they will work together more and more. It's going to be an interesting market space, and it's something that both Fez and myself are working day in, day out on, looking at different opportunities and trying to see where it does work and where it doesn't work. We're still learning, and the market is.
That's interesting. So you must I mean, I know we all sit pretty closely in the office together. You must be talking about this on a daily basis. A new piece of land comes in one way or another into the office. A landowner comes in, can potentially put 100 plots of land on his site, and let's say it's close enough to a local town with good employment, good local amenities.
I'll sell it.
Yeah, and it sounds like you'll have someone to invest in the exit.
Exactly that.
Yeah.
I think most of what Brad and I see, we look at together and look at both options and kind of try and work and maximise the returns for our client. I think the best and perfect scenario would be for us to come across a site which can take 200, 300, 400 units, and there's a bit of a hybrid approach of, okay, well, we can deal with 100 units for single family housing, and potentially the rest can go past lot to a traditional private sale exit.
Yeah, and that's good. I mean, that's what I've been trying to get. Ultimately, there is really good collaboration here, and it's clear that we're moving with the market in that sense. Just a brief step back on amenity. It fascinates me with built to rent. Personally, I'd absolutely pay for a gym and free coffee in the mornings. Well, of course, I'd be paying for it, and various amenities. In the first few years, Vez, how did that amenity look like in built to rent, and how has it adapted for that multifamily housing model?
Yeah, I think, it kind of became a bit like a TV in a hotel room. You need to put it in, whether it's used or not, doesn't really matter. I think now we've got the data across the UK of what residents want and what's actually being used. And I think, since COVID, we have seen this sort of impetus on, making sure there's enough co-working space and residents can stay within the scheme, but can get out of their flats to go to work. I think what's also been important is keeping flexibility so that amenity space can be redesigned in the future should shifts and demands change.
I think you just mentioned the point around the data now. I suppose it's worth mentioning, how do we get that data and where does that data come from, and how do we know that what you're talking about now is backed by that data? Where's it coming from?
I think operators, so we work very closely with Allsop Letting and Management, and they manage 6,000-7,000 units across the UK. So having that for us is really unique and really adds to our advice. And we can see where residents are going in buildings, what's being used, how much milk's coming out the coffee machine from your morning coffees, Jack.
So data's everything. I mean, it's a really good point. I'm trying to get Allsop Letting and Management down to a podcast record later on in the year. So keep your eyes out for that. So on amenity for your traditional housing estate, your single family housing, are you putting a gym on site? Are they putting those kind of amenities on site, or is it just look like any other housing estate as you would say?
You wouldn't know it's single family housing if you stood on site and you've got a private sale block and a single family housing block next to each other. I think the scale doesn't really demand it. Mm-hmm. We have been involved with housing schemes which are sort of 10-15 minute walk into a city centre, and we've got one where we're 100 units and we've not got any amenity. We've got another where we're 300 units and we have brought a couple of thousand square foot of amenity into that because we think the scale warrants it. But that's quite unique.
And what kind of amenity?
Dry gym, lobby, a bit of on-site staff. And
dry gym's an interesting point. So we're not talking swimming pools. Expensive.
No, we're not quite there. I mean, we see a couple of schemes, but predominantly in London.
So we've got a bit of a picture on how a build-to-rent single-family development would look like. Why should we engage with you, Sam, and your clients? And what's the benefit to me of going sort of down the build-to-rent route if I am a landowner and or a house builder?
I think day one, it gives you a certainty of sale. You are essentially 100% sold before you put a spade in the ground because you've got an investor there to take all the units on PC. I think looking wider than that, you've got an investor who's there long term, who's going to invest in that location and that site and want a return and an increase on their investment. So they're going to look after that and help the area. I think it also accelerates the infrastructure and placemaking. So I think, again, that's where it can sit alongside and work well with the traditional private sale model is you're getting increase of units delivered and you're accelerating, and that's potentially and hopefully going to have a positive effect on your remaining parcels.
Mm-hmm. I can see how that can be an advantage in today's market, something we were talking about earlier.
Yeah, I think to add to that, the risk element, which the build to rent arm is now essentially, it's not removing the risk because there's always risk in development. I think we need to give credit to where credit's due. This isn't easy for anyone, whether it's traditional house builders or build to rent operators. The fact that they can work together now is very important for the market. There is a target we keep saying 300,000 homes. Let's give credit where credit's due. If we can see another sector come forward and help that, then I think it's only a good thing. And from the perspective of the house builders, if they're buying, for example, a 500 unit site and they can sell 200 on day one, then why wouldn't they? There's a massive element of risk removed there. They can also deliver something that the councils like to see. They like to know that not everyone can get on that property ladder at day one. Maybe renting is the only way forward for some people. So it's a good opportunity to deliver a different tenure of housing. We've seen the affordable elements of the housing associations come forward more in recent years, and they've helped again deliver housing for people that need it. So I think in the main, you've got the traditional element of buying houses, you've got the affordable element in there, and now you've also got this potential other arm, which is built to rent and allowing people to rent in a secure environment. You've not got a landlord there that wants you out in 6 months' time. So I think there's those elements as well that you need to consider. And going back to the point of, I'm a landowner, why should I sell to either of you? There's not one answer to that. I think it's kind of each site needs to be looked at on its merits, and our advice as Allsop and two guys that are working in slightly different sectors but can deliver a similar product is that we will work together to come to you with what we believe is the best way to move forward with your site.
And it appears that it might well be a collaboration between your clients, Brad, and yours, theirs.
Yeah, exactly that, yeah.
Chaps, I just wanted to ask, finally, about your views on the upcoming year and where do you think your markets are going. Let's not get too hung up in the fact that there is going to be a general election, but crystal ball time, are things starting to look better?
Yeah, I think they are. Don't get me wrong, things aren't flying off the shelves like we'd all hope they would, but there is a view that money will become cheaper later down the line this year, and I think that will help stimulate. It's not going to take much to get the market moving again. So yeah, I think positively looking forward, I think we're in a good place.
If you look now compared to where we were 12 months ago, the market is much stronger. We're seeing much more capital there in the market, and there is a flight to quality at the moment. The investors that are there to do stuff are prioritising schemes with, that are progressed, and they're with good counterparties. I think as we progress through this year, hopefully we see gilts come down, we see interest rates come down, and we see construction costs continue to level, then hopefully we start to see things looking better.
Thanks, guys. That was really productive, and thank you for listening. I'm at jack.robson@allsop.co.uk. You find me on LinkedIn, sam.verity at Allsop, and brad.harris at Allsop as well, both active on LinkedIn. Thank you.